RAVE ran from about 25 cents to nearly $28, then collapsed hard enough to trigger exchange reviews. The pain point is liquidity. When a token moves that far that fast, late buyers can be trapped before they understand who controls supply. The RAVE crash was not just a red candle. It raised questions about trading patterns, token movement, and whether the market had enough real depth to absorb exits. That is why the first question is not whether the top was impressive. The first question is how many real bids were there when holders wanted out. The confirmed price path is extreme. RAVE surged to nearly $28 in a short period, then lost more than 80% of its value. Market data later showed the token near $1.39 within a day of the drop. That kind of reversal changes the question from momentum to market quality. A token can rise quickly because demand is strong, but it can also rise because available supply is thin. The difference matters when traders try to exit. A fast move can create the illusion that every token is easy to sell. The crash showed the opposite risk. The displayed price can vanish when the crowd moves in the same direction. RaveDAO denied being responsible for the price movement and said it was not involved in the recent action. The project also said it wants to operate sustainably and transparently while developing its Web3 entertainment platform. That denial is important, but it does not close the issue. A denial answers one claim from the project side. It does not replace exchange data, wallet history, or a clear explanation of how supply moved during the surge and collapse. The statement also left traders without a full supply map. If the project is not responsible for the move, the market still needs to understand which wallets had the ability to shape it. Binance and Bitget began looking into the trading activity after claims about concentrated holdings and unusual exchange flows. ZachXBT raised concerns that more than 90% of the supply could be linked to insiders, but that allegation has not been proven by the exchanges. This is where the RAVE crash becomes a market conduct story. The question is not whether social media is loud. The question is whether exchange records show patterns that confirm or weaken the insider control claim. Exchange reviews matter because platforms can see order flow, account behavior, deposits, and withdrawals that ordinary traders cannot verify from a chart alone. RaveDAO also discussed selling part of its unlocked tokens to fund hiring, marketing, and operations. That creates a second issue for traders. If unlocked tokens can be sold into a shaky market, supply management becomes just as important as the denial. The team has floated price-triggered or performance-triggered locks, which would limit when some tokens can move. But a lock idea is not the same as a schedule, a contract, or an independently visible rule. Funding operations through token sales can be normal for a young project, but timing matters. Selling unlocked supply after a crash can deepen distrust unless the rules are specific and visible. The practical signal is now very specific. Traders need exchange findings, not another round of vague statements. They also need a dated supply plan from RaveDAO if unlocked tokens are going to fund operations. The RAVE crash exposed a simple risk. When price, supply, and exchange flows move faster than transparency, the chart can punish anyone who arrives after the easy liquidity is already gone. If the reviews find no misconduct, the token still has to rebuild depth. If the reviews identify abusive behavior, users need to know how exchanges will protect future trading.